Hello everyone, welcome to my YouTube channel. In today's video, we are going to talk about a hotel company which has been able to double its annual revenue without owning a single piece of real estate. Yes, the company that I am talking about is Grand Continent Hotels. It has been able to scale itself from a single hotel with 54 rooms in Bangalore to its pan-India presence today. The company was founded in 2011 by Mr. Ramesh Siva and his wife Vidya Ramesh. They started with a single property in Bangalore and today it has a pan-India presence. As of FY25, the Grand Continent Hotel operates 20 hotels across 7 cities, totaling 956 keys. When I mention keys, it is nothing but rooms in the hotels. They are positioned in the mid-scale segment and they cater to mid-priced and upper mid-priced customer segment. The company follows an asset-light model in which they lease the property for 10 to 15 years and they also have some franchisee agreements with couple of brands. If I talk about the performance of the company in FY25 compared to the last year's financial year, they had 12 properties in financial year 24 and in FY25 it has been increased to 21 properties. In FY24 they had 532 keys which has been increased to 1014 keys. In FY24 they had 400 employees and in FY25 the employee count has increased to more than 640. The occupancy rate last year was at 66% and in this year the occupancy rate has dropped down to 61%. Although the decline in the decline in the occupancy rate is a bad sign, but in the case of Grand Continent, since it is very small, they had introduced a good number of hotels in the last 6 months and it takes time for a new hotel to reach its expected operating level. So due to this the occupancy rate is low. The income from operation last year was at 31.24 crores, which has increased to 72.62 crores. Let us now talk about the operating model of the company. The company follows dual operating model in which they have a franchisee model and an own brand model. In the franchisee model, they have franchisee agreement with Royal Orchard and Sarovar Hotels. The benefit of franchisee model is that they can use the brand name of these hotel brands for their own properties. One. Second, they get the SOPs from these branded hotels wherein they can learn how the branded hotels operate. Thirdly, they get a better visibility. Now, Royal Orchard and Sarovar Hotels, these are well established brands. So, whenever customer goes to their portal for booking a room, they will be able to see the hotels which are owned by Grand Continent also. So, this way they will get additional business as well. Now, coming to the own brand model. So out of the 20 properties that they have, there are 14 properties which are under the franchisee model. Now, the basic purpose of going with the franchisee model is that since Grand Continent is a new company, they wanted to understand how branded companies or branded hotel companies basically operate. So they have been operating 14 properties under the franchisee model through which they are learning how the hotel brands operate, what are the SOPs that they follow, what kind of service they offer to the customers. So with their learning, they are implementing those learnings in their own brand model. So the rest of the properties out of 20, they are all own brand model wherein, and going forward all the new properties will also be under their own brand model. So in the own brand model, the entire sales, marketing, operations, everything is taken care by the Grand Continent itself. And there is no need of paying any franchisee fee. So this way, any business that is generated by the own brand model or the properties which are under own brand model, that will have a higher margin compared to the properties which are under franchisee. So as I had mentioned, Grand Continent Hotel follows an asset-light model. We will know what this asset-light model is. So basically, Grand Continent, they take the property on lease for a long period of 10 to 15 years. So in this 10 to 15 years, they just have to pay the rent to the property owner and the entire property can be renovated as per their needs. So we will see what are the benefits of going with this leasing model. So first is the faster time to market. So whenever they identify a particular property, from the time of agreement to the go live, they just need 3 to 6 months of time. In this 3 to 6 months of time, they will do the renovation at the property, they will hire the staff, they will train them, they will do the installing of the furniture and all. So for them, the time to market is very less. It is just 3 to 6 months when compared to buying the land, building the structure, doing the renovation and then launching. That is going to be a very time taking process. So in this case, they are able to go live in just 3 to 6 months of time. So this way they can expand very rapidly as well. Now the second benefit of this asset light model is the cost effective exit strategy. So whenever they identify a particular geography for starting a hotel, they do a lot of research. They see how much demand is there in that particular geography, how many rival hotels are already present there. So once they have established a particular property and after a certain period of time they are observing that the business is not scaling there, so it is easier for them to exit from that hotel, because since they are in a leasing model, they can come out of that leasing agreement, they can get the security deposit back from the property owner and they can create a new hotel elsewhere wherever there is a demand. So it is easy for them to enter as well as exit from a particular location. The third benefit of this leasing model is that they are shielded from the real estate cycle. Now, since the leasing period is 10 to 15 years, so any fluctuation that is happening in the real estate market, that is not, they are not affected by that, because their rent is going to be standard, it is going to be constant, and there is going to be periodic hike in their rent. Now, it can be annual or it can be once in a 3 years, and most of the time it is 5%. So every year their rent will go up by 5%, or once in every 3 months, once in every 3 years, the rent will increase. So they have a very good visibility of how the rent is going to increase, or what their operating cost is going to be for their properties. Lastly, this asset light model will give them higher ROCE and faster payback. Now when I say faster payback, from the time the property is the inception of the property, they are able to break even within a span of just 24 months. Also, when they want to launch a property, it will only cost them 7 to 8 lakh rupees per room. Now this 7 to 8 lakh rupees also includes the security deposit which is given to the property owner, the renovation cost wherein they will do the branding inside the room, they will repaint it, they will put the furniture, all this cost is covered within the 7 to 8 lakh, and it also includes the initial operating cost for say 3 months. Because whenever a new property is launched, it will not suddenly operate at the expected level. It will take some time to reach the expected occupancy rate. So the initial 3 months of operating cost, which includes the utility expenses, which includes the staff expenses, all that is covered within the 7 to 8 lakh itself. So the cost required for them to expand is also minimum compared to the other business models that the different hotel companies follow. If we talk about the growth in the Indian hotel industry, according to the Hotel Association of India, the hotel and tourism sector in the short term, that is 2022 to 2027, it is poised to grow by 5% CAGR. In the midterm, that is from 2027 to 2037, the hotel and tourism sector is poised to grow at a CAGR of 13%. And in the long term, that is from 2037 to 2047, the hotel and tourism sector is poised to grow at an expected CAGR of 15%. If we talk about the market share of different hotel segments, so the hotels are classified into 4 segments. One is the luxury, second is the upscale, third is the mid value, and fourth is the budget. So the market share of mid value or the mid scale hotels is at 35%, and Grand Continent Hotel operates within this segment. If we also talk about the occupancy rate by hotel segment, again it is the mid value or the mid scale hotel which enjoys the maximum occupancy rate. The occupancy rate for mid scale hotels is at 72%. If we talk about the luxury hotels, it is at 60%, upscale properties or upscale hotels, it is at 65%, and budget hotels, it is at 68%. Let us now discuss about the performance metrics. Whenever you are analyzing a hotel stocks, there are three performance metrics that you should be aware of. First is the ARR, second is the RevPAR, and third is the occupancy rate. Now we will discuss each of these in details. Let us know about ARR. ARR stands for average room rent. What it basically means is, let's say most of the hotels, they basically follow dynamic pricing. Now you might have observed that the room rent on the weekend is generally higher when it is compared with the room rent during the weekdays. Also, in properties, leisure properties, like when you are going to Goa, during season the room rent is generally higher, and during off season the room rent is generally lower, right? So what ARR basically means is, what was the average room rent in the last 90 days. This is basically tracked on a quarterly basis, but it can be calculated for weekly basis, monthly basis, quarterly basis, and yearly basis also. So when we talk about ARR, in the context of Grand Continent Hotel, we are talking on an annual basis. So in one particular year, what was the average rent that they have charged to the customer, taking into consideration all the hotels and all the rooms that they have. Okay. The second performance metrics is RevPAR. Now before we talk about RevPAR, let us first understand the occupancy rate. Now what occupancy rate basically means? Let's say a particular hotel has 100 rooms. It is not necessary that every day all of those 100 rooms will get occupied by the customers, right? On a particular day it could be 70, the next day it could be 60, the third day it could be 90, the fourth day it could be 100. So it will keep on fluctuating. It is never the same, and the hotel room may not be fully occupied all the time. So it is on a weekly basis or monthly basis, again quarterly basis or yearly basis, the average occupancy rate is also calculated. So this tells you about the occupancy rate. Now if I tell you the occupancy rate was 70% in the last quarter, it means on an average 70% of the rooms were booked and 30% of the rooms were unoccupied. Okay, so the occupancy rate will give you an incomplete picture. Even the ARR will give you an incomplete picture. So to get the complete understanding of how well a hotel stock is performing, you need to look at another performance metric called RevPAR. Now what is RevPAR? RevPAR stands for revenue per available room. So from every room that you that you are offering to the customers, how much revenue you are getting out of it is nothing but the RevPAR. Okay. So in the case of ARR, the unoccupied rooms are not taken into consideration. Let's say there are 100 rooms and only 70 rooms were occupied by the customer. Then the average room rent is calculated based on those 70 rooms which were occupied. The 30 rooms which were unoccupied doesn't go into the calculation. That's why it does not give you a complete picture. So in order to get the complete picture, you have to look at RevPAR. So this is the most important performance metrics for analyzing any hotel stock. Not just Grand Continent. If you are analyzing any other stock like say Lemon Tree, Taj Hotels, or any other hotel stock for that matter, you have to look at RevPAR. So the RevPAR for Grand Continent Hotel has increased from 2164 in FY23, it increased to 2498 in FY24, and then there is a drop in FY25, it came down to 2447. Now why is this drop? Again, this drop has happened because they have introduced new properties, and new properties will take time to stabilize. In the early months of their inception, the business would not be at the expected level, so it will take some time for it to reach to the expected level. And because of that, since there was introduction of more rooms, the RevPAR has come down. Although it is a negative sign while analyzing the hotel stock in general, but since Grand Continent Hotels is expanding rapidly, so it is basically expected that the RevPAR would come down if they introduce more and more rooms, since the new properties will take time to stabilize. Now coming to the total properties that they had, in FY23 they had 9 properties, in FY24 it increased to 12 properties, they added 3 more properties, and in FY25 from 12 it increased to 20. So basically they added 8 more properties. If we talk about the revenue category wise. So basically Grand Continent hotels, they operate in three categories. They have three different category of hotels which they categorize. First is the leisure property. Leisure properties are closer to your holiday destinations, like it could be Goa, Shimla, Manali. So the properties which are placed in these places, they come under the leisure category of properties. Then they have business properties or business hotels. Now, if the hotels are located in metro cities like Bangalore, Chennai, Hyderabad, Pune, Mumbai, Delhi, so these hotels, they come under the business category of hotels. Now, most of the people coming to these hotels, they come there for business related work. There could be some percentage of people who are coming there for tourism also, but the amenities which are offered by the hotel, so it is done keeping in mind that the people are coming there for some work related purposes. Then thirdly, they have different category of hotels which they call it as spiritual hotels. Now these spiritual hotels are located near spiritual places like Dwarka, Ayodhya, Tirupati, etc. So how is the revenue split among these different category of hotels? So nearly 70% of the revenue comes from business hotels. Then from the leisure hotels and spiritual hotels, it is nearly 15% each. So this is the current split today, that is business hotel 70% and leisure and spiritual hotel, it is at 15%. But going forward, company wants to make a change in this mix. They want to bring down the revenue from business category to 60%. They want to increase the revenue in spiritual category from 15% to 25%, and they want to keep the revenue from leisure property at 15% itself. Now, why they do not want to focus on the leisure properties is that it is very seasonal. Like it will work during the season, and during the off season there is no revenue from those properties. So in order to avoid this cyclicality, they are not focusing more on the leisure properties. This is one. And secondly, a leisure property takes more time to reach the expected operating level or to reach their a standard operating level. So it takes almost 1 year time. In the case of business and spiritual hotels, it only takes 3 to 6 months to reach the expected or the expected operating levels. Now, if we talk about their segment wise revenue, so nearly 72% of the revenue comes from mid-priced hotels, and nearly 25% of the revenue comes from mid-upper priced hotels. So this is their pricing. This is the revenue as per their pricing. So the company wants to move towards mid-upper level pricing hotels. Let us now talk about the key financial highlights. Since this company is part of SME sector, so they do not release the quarterly results. Rather, they release the semester results. So the results are announced twice. The financial results are announced twice, and it is half year performance that they announce whenever they declare the results. So if we compare their performance in financial year 2024 with financial year 2025, so their revenue has increased by 132%. Initially it was 31.24 crores and now it is 72.64 crores. If we talk about the EBITDA and EBITDA margin, so the EBITDA has increased by 94% and there is a slight decrease in the EBITDA margin. The current EBITDA margin is at 26.4%. Now talking about the profit after tax and the PAT margin, the profit after tax has increased by 159% and the current PAT margin is at 14.7%. What is the way ahead for the company? So what is the journey over the next 3 years? Company wants to expand in different geographies. Currently they are more concentrated towards South India, and gradually they want to expand to west and north of India. So they plan to open new hotels in Dwarka, Jaipur and Ayodhya. According to the recent update, the hotel in Dwarka and Jaipur has already went live. The hotel in Ayodhya is expected to go live in the month of January of 2026. They want to add international destinations also in UAE and rest of Southeast Asia. There is one property in UAE which they are currently operating under the management contract. So apart from this, they also want to introduce more properties in their international market. Regarding the split between business, leisure and spiritual properties, I have already told you that they want to have 60% of revenue coming from the business hotels, 25% of revenue coming from the spiritual hotels, and again 15% of revenue coming from the leisure hotels. In the next 3 years, they want to grow their portfolio by 3x. So currently they have around 1000 keys which they are operating. In the next 3 years, they want to increase it by another 2000 keys and bring their total portfolio size to 3000 keys. Let us now see what are the key strengths of Grand Continent Hotel, or in other words, how Grand Continent Hotel is able to differentiate itself from its competitors. First is the founder himself. Mr. Ramesh Siva comes with a very rich corporate experience. He had an experience of 21 years of serving different hotels. He started his career with Oberoi Hotels, wherein he grew up the ranks, and then he became the CEO of India operations for Choice Hotels. Now, Choice is a very reputed brand. It basically comes from US, and then he has also been part of Sabri chain of hotels in Chennai. He was associated with Sabri chain of hotels for 7 years, and he has grew that hotel in a very rapid pace with a CAGR of 30%. So he is coming with a very strong background, which gives me confidence that he will be able to repeat the same story with the Grand Continent Hotel as well. The second differentiator for Grand Continent Hotel is their operating model. So when we talk about different operating models in the hotel industry, basically there are 4 operating models, and every operating model will have its own pros and cons. The first operating model that is there in the hotel sector is the owned property. So what do I mean by owned property is that the hotel company will buy the land, will build the structure, and will start operating that hotel. Now the disadvantage of this model is that it requires huge amount of investment, and it is very difficult to expand with this model. During COVID, most of the hotel companies, they realized that this model is very risky for them, because if they are not able to make business due to heavy debt that they have, they can go bankrupt. So lot of the companies, hotel companies, they have moved away from this model. So today they have mix of different operating models, but very few, or I would say in fact all of the hotel companies, they have moved away from this model. Now the second model that we have is the franchisee model. Now what do I mean by franchisee model? Let's say there is a property owner who has built a hotel, but he doesn't know how to operate that hotel, or since he is new in the market, people will not trust him. So what he will do is he can approach the hotel companies, or even the hotel companies can approach the property owner, and they can enter into a franchisee agreement. So with this franchisee agreement, the property owner will be allowed to use the brand name of the hotel company. The hotel company will provide training to his staff. The hotel company will also provide the SOPs as to how to offer service to the customers, and basically the know-how of how a particular hotel operates. And from this, the hotel company will take some margin or some commission from the revenue that is being generated at that particular hotel. So this is the second model. In the third model, it is called as management contract. Now let's say there is a person who has the land, who has constructed a particular hotel, but he is not interested in running the hotel. Okay, he is not interested in the day-to-day activities or the operations of the hotel. So in that case, again, he will approach the hotel companies. They will get into a management contract, wherein in the case of management contract, the hotel company will place its own staff. So they will also look at the operations now. In the franchisee model, they were not looking at the operations, and they were not responsible for getting the business also. But in the management contract, the entire operation of the hotel is taken care by the hotel companies. The property, and in return, they will take some margin from the revenue, and whatever is left is goes to the property owner. So the property owner stays invested in the hotel business. Okay. Now, lastly, before I move to the last operating model, the disadvantages of franchisee model is that it is very difficult to maintain the same standard and same SOP at every different property. Okay, so that is one disadvantage of the franchisee model. Now coming to the last model, it is leasing, okay, which the Grand Continent Hotel follows. Now, the only difference between owned property and leasing is that in the owned property, you own the land and the building. In the case of leasing, you don't own the land and the building, but you own the business completely, because the property owner is not part of the business. In rest of the two models, that is franchisee and your management contract, the property owner is also part of the business. Here the property owner is not part of the business, so you have complete control over it. So what they basically do is they will lease the property for a long tenure, that is say 10 to 15 years, and then the property owner will get a fixed rent, and the property owner is not part of the business. So one good advantage of this model is that you don't need very heavy investment to start a hotel. We have discussed the advantages of this model, and it is very easy to expand also. Like, you don't need huge amount of investment which you would require in the case of owned properties, and the property owner will keep getting his rent. So these were some of the advantages, this is how Grand Continent Hotel is able to differentiate itself from its competitors. So lastly, I want to make a disclaimer that this video is only for education purpose. Do not consider this talk or do not consider this as an investment advice. If you are thinking to make an investment in this stock, so please make your own research, talk to your financial advisor, and then take your call. This is one. Secondly, since this stock is part of the SME sector, so you will not be able to buy just one share of the stock. In fact, you will have to invest in the multiples of, or maybe you will have to buy the stock as per the lot size. Okay, so the lot size for this particular stock is 1200 shares. So and the current price is around 200 rupees. So if you want to invest in this stock, you will have to invest nearly 2.4 lakh rupees. So you cannot enter this stock by investing less money. So this is the second thing that I wanted to make clear. Third thing is that since this is an SME stock, it is very easy for you to get into the stock. But once you are invested, let's say there is any bad news with the company, or the business doesn't go off as expected, then it will be difficult for you to exit from the stock. Hence, if you are a retail investor, I would advise do not get into the stock. You do very deep research. If you are very much convinced, only then you put your hard-earned money into this stock. Otherwise, it would be good if you stay away from the stock. I hope this video was informative and you have gained some helpful insights on the topic. For more such videos, please subscribe to my channel. Until then, take care. Goodbye.